Hello, and welcome to my seminar for this evening. It is the Personal Tax Essentials. My name is Jodi Porteous, and I am so super excited to have you here. Tonight, we're going to run through some key aspects of what you can learn about your personal taxes. And I just wanted to say a big thank you for taking time out of your day to learn about this. So as you're jumping in, as you get acquainted with the software, because sometimes it can be daunting jumping into new software, please put in the chat whereabouts you're calling from or joining from today. So I'm going to do that myself. And I will be keeping an eye on the chat throughout the whole session. So if you do have any questions, please put them in as we go. And I do have a slide or two that just say, do we have any questions? So we can go back and address those questions. So big thank you for joining me. Today, we're going to be covering personal tax essentials. So I'm going to share my screen and we are going to get kicked on. Go. Here we go. Okie dokie. So, personal tax essentials, the 5 key areas for you to minimize your tax. Awesome. We've got somebody from Karratha. Thanks for joining. I recognize a couple of names there, a couple of people from Karratha, a couple of Northwest Accountancy clients. Hi, Travis. How are you? So welcome. So today, the key is to give you more information about how you can minimize your tax with a little bit of learning and a little bit of my tax agent view on all things personal taxes. So let's get started and straight into it. So we're going to talk about, you're in Chiang Mai. Awesome. Not far away from me, really, when it comes to where we are. So all over the world. It's awesome. So today, outcomes. We're going to teach you how you can calculate tax using tax brackets. So you might have heard of this terminology called tax brackets. And what I really want to show you is that it's not as hard as it sounds working out what your tax will be based on tax brackets. Then we're going to do a quick wrap up of what is the difference between the Medicare levy and the Medicare levy surcharge, because they use the same words and it's very confusing, but they're 2 separate types of taxes. Then we're going to run into the tax deduction side of things. So tax deductions for employees, work-related tax deductions, non-work-related tax deductions. So you can claim things even if you're not working. My favorite line item of a slideshow of no, you can't claim that. And some of the things that in our office at Northwest Accountancy, we've had people try and claim, and I'll tell you why they're not able to be claimed. And then we're going to talk about some of those biggest bang for buck tax minimization strategies. So looking at negative gearing, looking at salary packaging, and a few other things as well. And then stick around with me. If you're still on the call by the end of the call, then I'm offering a free tax planning meeting where we can turn around and talk specifically to your tax situation. And you can get a bit of advice straight from me and see if there's any ways we can help. So I say me, who am I? If you don't know me, my name's Jodi Porteous and I'm the Chief Educator here at Northwest Accountancy. I'm the owner of Northwest Accountancy and have been one of the owners since 2003. So just had my 20-year anniversary this year. I'm a tax agent. I'm a Profit First Master, so I provide cash flow advice. I'm a CPA, and my superpower is cutting out the jargon and easily explaining tax and money so that you can run your life. Now, it says business on there, but life also. And over the last 3 years, I've stopped doing tax returns and I've started doing more of these training sessions and advice rather than being stuck in the doing of the tax returns. And tell you what, I'm a lot happier for that. because I'm able to make more of a difference than just doing tax returns. All those 20 years of doing tax returns, I heard a lot of questions of what can I claim? Why is my refund so low? How can I get a bigger refund? Where can I go on holidays to get a bigger refund? So if any of these questions resonate with you, put a hell yeah in the chat, because these are some of the things that I hear over and over and over again. And when I said this slide out to my team the other day, when I was running through it, they're like, yep, they're still the same questions over and over again. So I've finally stepped away from doing tax returns, and now I'm here to teach you what you want to know about your personal taxes. So just a little bit of a refresh. If you're not familiar with Northwest Accountancy, we have done a little bit of a rebrand over the last few months, not so much in a logo rebrand, but with respect to how we tell our clients how we work with them. So we've got the 4 main things there. Cash flow clarity. So we talk about how you can manage your money. Make sure that your taxes are lodged on time, and minimize your tax and prepare early for tax bills. So that's the whole point of today's session. Relevant reporting. So in business, making sure your books are up to date, but also personally, making sure you know what you can claim so that you can bring that to tax time. And then structuring your life and yourself so that everything works, even when you can't work. So those are the 4 areas that we help our clients. And yes, we do personal taxes, and we also do business taxes as well. Okay, so I've talked about what we're going to learn, but what are we going to actually learn? So today we're going to learn how is income tax calculated, what you can do personally to make an impact, how to pay less tax, and maybe receive more refunds. Now, big disclaimer, everything in today's webinar is general advice only, and it may not be relevant to your specific circumstances. So if you're lucky enough to stay on the call and have the one-on-one with me, you can ask all your pertinent questions. But if you're not, then check with the tax professional, check with your payroll department if the initiatives will work for you. So in regards to negative gearing, and I'll explain this further on, but negative gearing means you're spending more money than what you're receiving in as rent. So please make sure you can afford to borrow and repay the loan even without that requirement for rent, so it doesn't put you in a place of hardship if a tenant does not pay. So please be aware that everything I say today may not be 100% relevant to you. So take what you need and ignore what you don't. And like I said, stick around with me and we may have a chance to chat about your personal circumstances and how anything I talk about today can impact you personally. Awesome, let's get started. So, income tax. Now, income tax is calculated on your taxable income. Now, that sounds really simple, but it can be a bit of a formula. So taxable income is made up of your gross wages and salaries. So if you're an employee, then you're probably getting a pay slip, and the gross, now I say gross, and I will explain this in a slide further on, your gross wages and salaries. So it's not the amount that hits your bank account. Any other income, so we add your gross wages or salaries to any other income. So interest, dividends, allowances, rent, anything else that you're earning goes on top of your gross wages. Now, for anybody who's in Rio, Woodside, BHP, FMG, all of those big mining companies, and there are some smaller companies as well, you may be given free shares by your employer. So they're called employee share scheme. So if you get free shares given to you, then yes, that forms part of your taxable income as well. Then once we've got all of your income bunched up, then we can reduce it by your tax deductions. And so part of today's webinar is running through what some of those tax deductions could look like for you based on your job or based on who you are. Now, the word tax deduction is interchangeable with tax claim or claims. And so when somebody says, can I claim that against my tax? It means, can I get a tax deduction for it? So I love taking the jargon out of things and explaining them. So those words are the same, they mean the same thing. So a tax deduction and a claim. So a tax deduction is something that comes off of your taxable income, and you are reducing the taxable income, therefore reducing the amount of tax that you need to pay. And then we can reduce it also by any non-work related tax deductions. So you've got your you've got your deductions against your income. So it might be wage related, it might be interest or dividend related, it might be rent related, allowance related tax deductions, and then we've also got those non-business related tax deductions as well. Okay, what is pay-as-you-go withholding? So pay-as-you-go withholding is the tax that work pays for you when you're receiving wages. And why is this important? Wages tax is the tax that work has already paid for you based on your taxable income. So you'll get your pay slip. And in this example here, working for 30 hours a week at $30 an hour, you'll get paid a gross pay of $900. And then from there, work's going to take out tax for you. So they're going to take out $127. So in the world of jargon, that's called PAYGW. And your employer will pay that pay-as-you-go tax to the tax office on your behalf on a point in the future. So they might be registered to pay on a monthly basis, they might be registered to pay on a quarterly basis, but they will be paying that to the tax office in a later stage. So be aware of that one, they don't pay it on payday. Then the net pay of the $773, that's the amount that goes into your bank account. From there, your employer also has to put aside $99 to pay superannuation on your behalf as well. So that $99, yet again, they don't need to pay it today. It needs to be paid at some point in the future. Generally, superannuation is paid on a quarterly basis. So you might have superannuation assigned to you or allocated to you today, but it won't be due for payment for nearly 2 months. And so just be aware that that doesn't necessarily always go into your super fund bank account straight away. These numbers, so the gross pay, the pay-as-you-go withholding, the net pay, and the super, as well as anything else on your pay slip. So there might be allowances or there might be deductions. They're all reported to the tax office on payday now via single touch payroll, STP. And this you can then log into your MyGov account and see these numbers in real time based on what has been submitted to the tax office by your employer. So you can see that money in your MyGov account. The pay-as-you-go withholding, that's the wages tax. And this is important for in a couple of slides' time when we work out how much tax you're paying, because work's already paid some for you. Net pay is what you get in the bank, and superannuation is money that's going to be banked into your superannuation fund at some stage. Okay, how do we calculate tax? Once your taxable income is calculated, then we can work out the difference between the tax due and the tax already paid. So this is where the pay-as-you-go withholding comes into it. So we've got our gross income, we've got our tax deductions, the claims, and then we've got the tax that work has already paid. Now your employer calculates the amount of tax that you need to pay based on only what they know. So they base it on your gross wages. They don't know if you've got any other income. They don't know if you've got any other expenses. They don't know if you've got negative gearing. They don't know if you've got children. They don't know if you live in a zone area. So all they can do is calculate how much tax based on what they know. And it's all legislated so that you can go to the internet and go, how much is the tax on X amount of dollars per week? And it is the same amount generally as what work takes out. So they pay that pay-as-you-go withholding tax to the tax office, and we use that number when we're preparing your tax return. If your taxable higher income is higher than what work has said, then you'll probably have a bill to pay, because they're supposed to be working out the right amount of tax to withhold from your taxable income. And so if you've got more money coming in, so you might have rent that you've received or interest that you've received, then you may have a bill to pay. If your taxable income is lower because you've got tax deductions, you've got negative gearing, you've got claims, then you might receive a refund back. And that's the way the tax system works. It's a system where everybody guesses how much income you're going to get, how much tax you need to pay over the year. And then the tax return is that finalization of the year to work out more or less. Do you need to pay more? Do you need to pay less? I tell clients who not have a whinge, but exclaim that I only got a $300 refund this year. Why? Is the reason why is you've had exactly the right amount of tax taken out for you for the whole year. And so good work for work, taking the right amount out. So you've not got a huge amount. You haven't missed out during the year, and you don't have a huge amount to pay back. So the ideal world is to not have anything due when we lodge your tax return. But of course, everyone wants a refund. So I'm always on the side of, if we can give you a refund, let's do it. Okay, let's have a look at our simple tax income calculation. So I've got very, very basic information here just so we can run through some numbers. So Mr. Simple Client, very, very unimaginative names. For the year of July 22 through to June 2023. So that's our tax year from 1st of July until the 30th of June. They've had income from gross wages of $122,476. Then we add on the interest from the bank account. So a total income of $122,481. And then we take out the expenses. So we take out the tools, we take out the tax preparation fees, we take out union fees, we take out telephone. And you can see here that I've apportioned the telephone. So $100 a month, but we're only claiming 40% for work. So our total of our expenses is $2,481. So that gets us to a nice round figure. Do you like how I did the maths on that example? A nice round figure of a taxable income of $120,000. So the $120,000 is then filtered through to these tax rates. So we've got tax rates here. Round numbers do make my life easier too. And you'll see why on this example, because $120,000 is one of our tax brackets. So 180, zero, if you earn between $0 and $18,200, then there's zero tax to pay. So if you earn $9,000 as your taxable income, then you've got no tax to pay. If you then earn between $18,201 and $45,000, then you're taxed at 19 cents in the dollar for every dollar earned over $18,200. So if your taxable income works out at $18,202, so $2 more, then it's only 19 cents of those $2 each that you will owe to the tax office. So every single tax bracket, so every line on here is called a tax bracket, has its own different percentage or its own different cents in the dollar amount. So the $45,000 to the $120,000 tax bracket is $5,092. So if you earned exactly $45,001, you would pay $5,092 in tax. Because we've gone round numbers and $120,000, $120,000 tax bracket, you will pay $29,467 worth of tax. Now, when it comes to the plus the rest of it, if you earn $10,000 more, so you earn $130,000, you pay $29,467 plus $3,700, which is 37% of $10,000. Now, your taxable income is based on these tax rates. And once you've got the hang of using the calculator, it's reasonably easy. And what I like to say is your top tax bracket, so the $180,000, you're being taxed at 45 cents in the dollar for every dollar you earn over 180,000. So if you're on the top tax bracket, which some people are, then you're not being taxed at 45 cents in the dollar for everything that you earn. It's only for the amounts you earn over 180,000. So worst case scenario, I do my tax planning at the top tax bracket. But if you're on a lower tax rate, then you win because I'll overestimate the amount of tax that you need to pay. Now, word of warning, these rates do not include the 2% Medicare levy. So everybody pays the Medicare levy. These rates are not inclusive of those Medicare levies. So actually the top tax bracket is 47 cents in the dollar, not 45 cents in the dollar. So you might hear me say 47% and go, what's she talking about? It's because I automatically round up and include the Medicare levy in my calculations. Okay, here we go, on to the next slide. So for somebody earning $120,000, like my little yellow example a couple of slides ago, tax is that $29,467 plus the 2% Medicare levy, so $31,867. So that's how much money you would pay in tax. And generally we would find if that's your wage, then that's how much tax work would have paid out, give or take. I'm going to give you a different example of $60,000. So $60,000 is right in the middle of this $45,000 to $120,000 bracket. And let's do the little calculations. So we start with the $5,092 because that's the tax on $45,000. And then with the difference between the 45 and the 60 is $15,000. So that's at 32.5 cents for every dollar. So that's another $4,875 in tax. So those two added together is $9,967. Then we add the Medicare levy. So 2% of $60,000 is $1,200. And so you would pay, if your taxable income is $60,000, you would pay tax of $11,167. Now, the way the tax brackets work is this first person earning $120,000, the total amount of tax they're paying is $31,000. This person here with earning $60,000, they're earning half of that 120, but their tax is less than half. And the reason for that is because the tax brackets are weighted to a higher tax bracket. So the more you earn, the more tax you pay. So would you rather earn $60,000 and pay $11,000 in tax and have, what's that, $49,000-ish in your bank? Or would you like to earn $120,000 and pay $31,000 in tax, but have, what's the maths on that one, $90,000 in the bank, give or take? So that's the trade-off. Yes, you pay more tax, but actually you've got more money in the bank as well. Okay, moving on. Medicare levy. Hopefully everybody's following that. Give me a thumbs up if you are. Cool. Medicare levy, 2% of your taxable income. So why do we pay the Medicare levy? Awesome. Medicare levy helps us fund the public health system. So we are paying for hospitals, we're paying for Medicare, we're paying for free and for subsidized treatments. So that's what the Medicare levy is built in for. Now, when work taxes you with their pay-as-you-go withholding, that is already incorporated into the tax that they pay for you to the tax office. Now, there's a couple of exclusions. My general, what comes out of my mouth is everybody pays the Medicare levy. Except, there's always an except with tax. It's not payable by low income earners. So if you're a low income earner, you earn under $24,000, or if your family earns under $40,000 for the year, you don't pay Medicare levy. which is great. But those thresholds change depending on if you're a senior and depending if you've got multiple children. So those numbers will go up slightly depending on your personal circumstances. So the Medicare levy is payable for everybody except for low-income earners, for seniors, and people who don't have a Medicare card. Now, the Medicare surcharge. Now, I love being a jargon buster. The correct terminology for this is the Medicare levy surcharge. So it's the MLS that you'll get charged. But because we've got the Medicare levy, I hate putting the extra word in and calling it the Medicare levy surcharge because that's really confusing. So I just call it the Medicare surcharge. Yet again, another bit of jargon busting. The surcharge is based on your income levels as an individual or for your family. It is based on whether you have private hospital coverage or not. So if you've got essentials, essentials, I keep on trying to say hospital cover. You have to have hospital cover for you not to pay Medicare surcharge. And then your surcharge is also based on whether you've got a tier with your health fund or not. So let me use those words again. If your health fund only covers you for essentials, then you still may be liable for surcharge if your income thresholds go too high. So the surcharge does not come into play if you've got private hospital coverage, but it does come into play depending on your income. It does come into play depending on your health fund. Okay, here we go. Tier rates. What are the tier rates? So your Medicare levy surcharge rates are dependent on how much you earn, whether you're a family or a couple, and whether you've got private hospital cover or not. So if you have private hospital cover, you do not get charged the surcharge. So don't stress too much about this. If you don't have hospital cover, then you need to worry about these surcharges. So if you earn more than, as a couple, $288,000 combined, then your Medicare surcharge is 1.5% of your income. And now this is each. So depending on, so it's based on a combined income. So you'll both do your tax returns separately because that's the way the system works, but you'll get that added on as an extra 1.5%. So we're pushing that top tax bracket without private hospital cover from 45% up to 47% with Medicare levy, up to 48.5% with the Medicare surcharge. So sometimes cheaper to get the private hospital cover than what it is to actually pay the Medicare surcharge. So happy to do some maths with you on that one and see if it works for you. Now, another thing that comes up on tax returns is people not claiming the right tier amount. So if you sign up for private hospital cover and you tell them we've got really low income, so $100,000 combined, but really when you lodge your tax return, you're up in the top 3 tier, then you're going to have to pay that surcharge on your tax return rather than as an increased premium by paying your private hospital cover. So you're going to pay it at some stage, whether it's paying it extra to the private hospital cover, to your health provider, or in your tax return to the Medicare levy surcharge adjustment. So be mindful of that one. It can be strategic whether you want to pay it later when you lodge your tax return or as you go, as you're paying your health fund. But that Medicare surcharge is really important, and we find it makes a huge difference to people's refunds if they get that tier wrong, or if they didn't realize they needed private hospital cover and they've gone over a specific threshold. So be mindful of that one. Okay, time for me to take a drink. If you've got any questions so far, please put them in the chat and I will answer them in a second. Awesome. Brilliant. Are we still in alliance with Pegasus? Great question. Got nothing to do with today's webinar, but I will answer it anyway. So the simple answer is no. The owner of Pegasus, Robin Donison, and I have parted ways. We are not co-owners anymore, but we still do talk and we still do refer work to each other where we need to. Awesome. Okie dokie. So let's keep going. What are our best tax deductions? So my first biggest tip for tax deductions is keep your receipts and keep your proof of payment. There's been multiple times where we've had people walk in the door and say, the tax office has contacted me for an audit and all my documents are gone. What do I do? And the ATO auditors are not always our friends. And if you can't prove what you've paid and how you've paid it, then they don't care. Oh yeah, dependents. Good question. So a uni student, any student under the age of 25 is classed as a dependent for Medicare purposes. So if they are under 21 and in full-time work, then they're still your dependents. But if they're under 25 and a student, then yes, still your dependent. But their income doesn't get counted in the family income rates. So that's a good thing. So if they've got an extra job or whatever, then they're still your dependent regardless of whether they're working or not. Okie dokie. So number one, my biggest tip is keep your receipts, keep your proof of payment. You do not need to keep the actual physical paperwork. I just threw a whole lot out yesterday. Your receipts can be kept in digital format, and that's probably a good thing in most cases, where you can take a photo or scan them in, keep them in a tax folder. So I've got a folder set up in our electronic Apple filing system, just with a folder for each financial year. So take the photos of the receipts, save them straight into that folder. Then I've got that digital proof of what it was for. And if it's not clear what it was for, I just handwrite on it before I take the photo what it was for. And there's my receipt, there's my proof of payment. And there's a really good way to keep all of my documents together for tax time as well. So that's my very first most important tip. Secondly, you can't claim a tax deduction if you don't pay for it. So if work pays for something, then you can't go ahead and double dip and claim for that as well. An example of that might be a laptop. So you go out, you buy a laptop, and then you get the receipt and you hand it into work and they repay you for that. They're going to claim the tax deduction, you're not able to. So just be aware that if they're claiming it, you can't. And the general rule of thumb when it comes to tax deductions is if there's a link between your income and the cost, then it will generally be tax deductible. So there's got to be some sort of link or a nexus between the cost and the income, and then we can generally find a way to make it tax deductible. And you can claim, so that is, you can claim something that you've paid for that you use exclusively for work. And the word exclusively is in there on purpose because you can also claim things that you don't exclusively use for work, but you do need to apportion it down. And with our example back with whatever simple client was, we only claim 40% of the telephone because the other 60% was for private use. And there we go. If you keep the records, you can claim you can claim the work use of something you use for both work and private. Okay, here's some of the common things that our clients claim. Vehicle costs. Now, there's lots of rules around vehicle costs. So my best tip here is keep a logbook, keep a record of all of your expenses, and your logbook only needs to be for 12 weeks of the year. So for 3 months, which is 12 weeks, you can keep a little log, and it does not have to be handwritten. It can be on an app. The tax office has an app that you can use as a logbook as well. And it's for driving, not from work to home or home to work. It's for driving for work purposes. So generally from when you're at work, at the office, at the warehouse, at the yard, to somewhere else, and then back to the yard again. Well, those trips are generally claimable, whereas the home to work, generally not claimable. And of course, there's always exceptions to rules. Phone. Yet again, apportion your phone, but if you do use it for work purposes, keep a record of how much you use it for work, and that might be downloading some statements and doing some highlighting, or keeping a log of the number of calls that you're making throughout the day that you're charged for, and making a claim for that, or getting a tax deduction for that. I like how I interchange that. Any tools that you use for work, laundry, clothing, and boots. So the tax office has pretty strict rules about how to claim laundry, but it's a standard charge that you do not need a receipt for. So I like that one. Clothing and boots. So just be wary with clothes that it has to be work specific. So if it's not got a logo on it, it has to be occupation specific. So if we think of a chef, for example, you generally picture a chef with the white coat and the checkered pants, and that would be occupation specific clothing that you can claim because it's something that we identify with that industry, with that occupation. Boots, absolutely. Let's go. Memberships and subscriptions. So those things that you use that you help you do a better job are claimable for you at work. Licenses, yet again, not a car license, but if you're a forklift driver for work, then your forklift license. Or if you're a semi-truck driver, then your semi-truck license. F-class, I think that is. Bus license, I don't know, all of those things. Union fees if you're in a union. Self-education courses. So be mindful with self-education, there's got to be that link between the income that you're receiving right now and the cost that you're doing. So if your self-education is nursing, but you're working as an accountant, that won't be claimable. I'll get to that in a minute, Herman. But if you're doing training as an accountant and you're working in an accounting office as an accountant assistant, then absolutely it is claimable. So subscriptions for investment properties and shares, definitely claimable. They're just not under that work-related title because they're not related to your work. So yes, they are related to income. So a subscription for an investment property or share investment purposes, absolutely claimable. There's that link. Working from home is claimable. However, they changed the rules in 2022, 2023. So for this tax return that we're currently preparing for our clients at the moment, the working from home rules changed. So if you have been working from home, they want you to prove how much extra you paid because you worked from home. And now that's super tricky. So definitely worth looking into the rules as to whether you can claim working from home or not, and how it impacts on you. And then the other thing is these occupation specific guides to work related expenses. So there's all sorts in there, and Google occupation specific guides, ATO, and this will give you the whole list of all of the different PDF summary and posters that they have for the occupation. So I've got a little screenshot there, everything from agricultural workers to teachers to miners to call center operators. There's flight attendants, there's all sorts of occupations in there. And it gives you a little fact sheet about the different things that you can and can't claim. So that's a really helpful tool if your occupation is there. If your occupation is not there, then it gets a little bit confusing. But for the most part, when I've opened them up and had a little look through, a lot of them are very similar. And it all comes back to what can we claim? Is there a link between the income and the costs? If there is, then generally we can claim it. Go to ato.gov.au, search for QC72193, and that should take you straight to that page rather than doing the longer search of occupation-specific guides. Awesome. So here's the non-work related deductions. So this is where the other things that can come in that are not specifically work related. So donations to charities, income protection insurance, tax agent fees. So coming to see us in our office to get your tax done or ongoing tax advice. Also, keeping your tax records organized. So I mentioned before about having a little subscription for Apple to keep all my documents online. You can claim a portion of that subscription for keeping the tax records organized. Same with this, if you go to the newsagent and buy a folder to keep everything together, you can claim that as well. Costs to earn other income. So interest, dividends, rent. So rent, anything that's rental related that you spend in, yeah, I will, yeah. I will expand on income protection in just a moment. So anything you spend in relation to earning rental income is claimable against that rent. Anything you pay for in relation to earning dividends is claimable against those dividends. So things like a subscription to a share trading memberships or site, or financial advice from a financial advisor. Now, the one thing that is different with that one, your upfront fee for your financial advisor is not tax deductible, but the ongoing advice is. So just be mindful of that one. And then interest. So if the bank gives you a portion of interest, but then also takes away some charges for the privilege of earning that interest, then that nexus is met. So the income relates to the cost, and so off we go. So income protection insurance is the insurance that you get if you are unable to work. And generally the income protection insurance policies will cover you for a specific period of time after you cannot work. And it can be in relation to being sacked or fired, and not being able to get another job. It could be because of sickness or health issues. So it could be for cancer, it could be for permanent disabilities. So having a leg dismembered from you, those sorts of things as well. And it can be, as I had a client a few years ago who was a physio, and because she got arthritis in her hands, she was able to claim income protection insurance to pay for her to stop working. And it covers the income that you would have received if you were working. And so the income protection insurance claim is how much you pay for the policy each year. And then if you do collect from that insurance money, then that is taxable when you receive it in that name. Hopefully that makes sense, Herman. Another one you can claim is superannuation that you pay yourself. So work is required to pay superannuation, and at the moment it is 11% superannuation, and that'll go up to 12% superannuation soon. If you wanted to, you are absolutely able to put more into your superannuation fund and apply for it to be a tax deduction as well. Now, there are always rules around superannuation, and the cap for this year is 27,500. But if work puts in 10,000, you've still got 17,000 that you can put in yourself and claim as a tax deduction. And that has a double whammy. So number one, it gives you more money for retirement. Number two, superannuation is taxed at 15% for most people. Sorry, high income earners, not 15% for you. And you're getting a tax deduction in this year as well. So no tax in your tax return on that amount, a lower tax rate in the super fund, and money for your retirement. Awesome. Okie dokie. Common issues in audits. Not keeping records. like I said, you can miss out on big claims if you don't have the right records when it comes to audits. You can get late lodgement fines if you are not lodging on time, and then doubling up. So one person came to me a few years ago and he did his own tax return, and he was claiming the cents per kilometre method of claiming his vehicle. Plus, he'd added up all of his fuel and servicing for the year as well, and was claiming both. So some things are not all, some things are either or, and cents per kilometre is definitely one of those with regards to vehicle. You can only choose one method of calculation for calculating how to claim your vehicles. So be careful of that one. Claiming ordinary everyday items such as socks and underwear. So we've had a few people go, yeah, but I need those socks for work. They're so comfortable. Sorry, the tax office does not see underwear. They see outerwear as clothing or protective clothing for work. And then making sure all your records are kept securely for 5 years after your tax return is lodged. So there is some people are on a 2-year amendment plan with the tax office. And so if you don't need, I know, right, bamboo socks, unfortunately they take so long to dry, but so comfy, so comfy. Make sure all your records are kept securely for 5 years. So for most people, we've got a 5-year amendment period, but for some simple tax returns where you're not claiming much, you don't have rental properties, you don't have shares, you don't have employee shares, those sorts of things, then you might be sitting on a 2-year amendment plan, in which case you only need to keep your records for 2 years after your tax return is lodged. But for safety's sake, I always recommend 5 years, just in case, And if you're keeping them electronically, you don't have to dig around in your filing cabinet. Okay, my favorite one. You can't claim that. Life insurance. So like I explained with income protection insurance, that income protection insurance replaces your ordinary income, and you would pay tax if you received the insurance money. We don't want to pay the money, pay tax on the life insurance money when it pays out. So that's not claimable when we do our tax return. The next one, dogs. I love every time somebody asks me, can I claim my dog? No, sorry. Your fur children are not tax deductible, and generally very rarely are they anyway. So it used to be the thing back in the 80s. Back before my day, but most business owners would have a dog as a security dog, and it would end up being, upon audit with the tax office, a small little fluffy yappy dog, and the tax office is like, are you kidding me? They're not a security dog at all. So sorry, can't claim your dogs, can't claim your pets, can't claim your vet bills. GoFundMe donations. So these ones are generally not tax deductible gift recipients, because the GoFundMe donations are set up by mates to help a family in need. So they're not a registered charity. They're just helping your mates out. So not tax deductible for the GoFundMes. And most of the people who ask me, hey, can I claim this? It's like, no, sorry, it's not a registered charity. And they're like, it's no problem. That family really deserved it, or that guy really needed that money, so I was happy to help anyway. So some donations to charities, absolutely, you can do them out of love, but you can claim the tax deduction for it. Unfortunately, not the GoFundMe style. Same with raffle tickets. Now, raffle tickets are really popular, where you can buy that raffle ticket and win that beautiful house on the Gold Coast. Don't claim the Gold Coast ticket. Now, the reason for that is, yet again, the same as some of the other reasons. You don't want to pay tax when you win the house. But also, yes, they might be a registered charity, but you're actually winning something significant and substantial for that. So we don't claim the raffle tickets because it's not a donation, it's a chance to win. And then I've received so many of these. back in the day when a lot of people would come in with their shopping bags or their shoe boxes. I actually have received shoe boxes on my desk. You open up and it's full of receipts, and you're like looking at them all and asking the client, so why did you put this in the box? And they said, well, it includes the word tax invoice on it, but it's a tax invoice from KFC for dinner, and it's a tax invoice from Kmart for a new pair of shorts, and it's a tax invoice from the sports store for some sporting equipment. And it's like, tax invoice doesn't mean tax deductible invoice. So there's some jargon that I want to teach the world here. Just because it says tax invoice doesn't mean you can claim it. And when you go to Woolies and Coles, they say tax invoice on the top of their receipts as well. My favorite the moment was when a client who had an ATO audit came to me and said, so my other accountant told me I could claim coat hangers for hanging my uniform. They were a police officer, and so there was a lot of different things that this other accountant had told them. They could claim their belt buckle, they could claim the coat hangers for hanging their uniform, they could claim all sorts of just random things that were not linked to going to work. And so the tax office doesn't care if you hang your uniform or, oh, good question, Rochelle. The tax office doesn't care if you hang your uniform or fold it up nicely. That's got nothing to do with your work. So not claimable. So Rochelle's just asked about, what about a work bag? Now I love this question because the tax office actually has guidance about this. People must have been asking for years. If your work bag houses work equipment, so for example, it's big enough to hold your laptop and you take your laptop to work from home, and then you carry that laptop back to the office or you go see clients with it, then that work bag is then a tool of the trade because you're carrying it around with the items of your work. If your work bag is I'm just going to throw it out there and go, it's a beautiful Gucci bag and it's about this big and it doesn't hold anything other than some lipstick and a bit of cash and your phone, then it's not a work-related expense and it's there for you for your personal use only. So depends on what you stick in the bag as to whether it's claimable for work or not. Hopefully that makes sense, Rochelle. And then you can't claim anything private or work, non-work related. Okie dokie. So have you done your tax return already this year? So we're 6th of September. So we're 2 months into tax time. We've actually just been doing tax returns for 7 weeks now. So if you are ready to do your tax return, then we've got 3 ways to do your tax. So we can do it as an appointment where we do it together, sit down either on Zoom or in our office in Karratha, and whack it out, for want of a better word. A drop-off tax return where we do it for you. So you can fill out an online form, upload all of the information, send it in, and we will process that tax return on your behalf. And you don't even need to be in the same room, in the same town, in the same country even. And then the final one is the Check My Tax. So the Check My Tax service that we have is you doing your own tax return online on your MyGov account and then doing a Zoom appointment with myself to get it checked before you lodge that tax return. So that has been helpful for the clients that I've used it for. I've used it for a few of our clients where their children just need a really simple tax return. They've done it all themselves. They just want that peace of mind to get it done. So happy to help you out. And if you do want to get your tax return appointment sorted, then northwestaccountancy.com.au and go to the tax tab. And we've got all those 3 different ways to work with us, all itemized out on that page. Awesome. Are you ready to minimize your taxes? So we're going to talk about negative gearing. We're going to talk about property and shares. And we're going to talk about salary packaging. So giving up cash or access to something else. And that's all salary packaging is. And then we're going to talk about earning less money. And this is a little bit tongue in cheek, but it's also another way to minimize your taxes as well. Okay, so let's talk negative gearing. Who here has properties? Put a little yes or a thumbs up in the chat if you've got a property. So with our negative gearing, we've got an example here of a rental schedule. So up the top, we've got our rental client. They've got their rent coming in of $15,600 per year. I think that's $350 a week in rent. I don't know. I did this a while ago. And then we've got the costs coming out. So the standard tax deductions that I see coming out of tax returns with rental properties, council rates, water rates, depreciation, insurance, interest on the loan, and maintenance. So those are the main key ones that I'll look for. Now, depreciation is a calculation of the cost of the build of the house over the lifetime of the house. So the tax office says that a house will last 40 years. So the depreciation is claimed based on how much it costs to build that house over that 40-year period. Insurance is claimable based on how much you're spending for the year. Interest on the loan is interest that you're paying to the bank, not your full repayment amount. So your cash position is going to be different than your tax position. So your cash position is going to exclude the depreciation, but add on how much extra you're paying on the principal of the loan. So just be mindful of this. We're only looking at the tax consequences here, not the cash consequences of your negative gearing. So in this situation, we've spent $22,500 on expenses, but we've only earned $15,600. So this income goes into your tax return, and then the costs go out. So we're negatively geared. So we've spent more money than what we've got in of $6,901. So this amount here reduces our taxable income. We're going to use our $120,000 client, take off the $6,901. So that gives us taxable income of $113,099. Now, this means that your refund amount will be the difference between what work has taken out for you based on the $120,000 and what your tax on $113,099 is, which is the lower amount. I wonder if I did the calculations here. Probably not. So an estimated refund after I did the calculations of $2,382. So can you compare that $2,382 refund to the amount that you're out of pocket, which is nearly $7,000? So just be wary, because we're in that 37% tax bracket, I think it was, including Medicare. You're only getting 37% of what you spend back as a refund. So my sideways things that I've put in as well. Where your income is less than your expenses, that's what negative gearing is. It reduces your taxable income. You've paid too much tax because work doesn't know about your negative gearing. And then my final little one in italics there is beware of your assets that do not increase in value. So having negative gearing is okay for short term, and it's okay for assets or for buildings or properties or anything that you're investing in that you're claiming as negative gearing. If the assets are going up in value, then the negative gearing will help time out the taxes. But if your asset does not increase in value, then there's no use holding an asset that doesn't make you money. So that's one of the reasons why negative gearing is a thing, is because they expected that you would lose money in the first 5 to 7 years, but you would make that money back up again when you sold that asset. And unfortunately, with property prices happening over the last 12 to 15 years, they've been all over the place, and there's not been that direct correlation between buying an asset and making money like there was in the 80s and 90s. Okie dokie. Right. Any questions for negative gearing, stick them in the chat and I'll come back to them. Salary packaging is one more thing before I go back, start on salary packaging. You can negatively gear for shares and managed funds as well. So that doesn't involve all of the things like insurance and maintenance and depreciation and stuff like that, but it will involve the interest that you borrow to buy those shares. So you can claim the interest that you borrow, yes, against the dividend income that you make. So you can negative gear for shares as well as property. Shares are a lot easier to sell than a house. You can't sell a bedroom. You can definitely remove some of your share portfolio and keep some of your share portfolio. So shares are a lot more flexible, but a lot more scary for people because they don't always understand it. Moving on, salary packaging. So giving up cash for access to something else. So that's the broad definition of salary packaging. It does need to be documented properly. So you need to sign the documentation before payday for a valid salary packaging agreement. And salary packaging can be all sorts of things. Most commonly, salary packaging for superannuation, and I even do this. So I give up some of my income to pay more money into superannuation, and it gives us a better tax implication. Another thing you can salary package is your car. So just be wary of salary packaging with vehicles because there may be some FBT, some fringe benefit tax implications. You may have to pay some of an after-tax contribution as well as the salary packaging contribution, which is before tax contribution. And so some of the calculations I've seen from salary packaging providers are saying, well, we'll take $500 out of your pre-tax, and we'll take $600 out of your post-tax. And I'm like, that doesn't work for you. So just be mindful if you are going down the car aspect, do your sums properly. There's not many situations I've seen over the last 5 years of salary packaging that actually work in favor for the people doing the car salary packaging. Now, my only except for is electric cars. So just this year, so the 22-23 year, electric cars have got an FBT exemption. So if you are interested in buying an electric car, then salary packaging an electric car can really help reduce your tax. Then we've got things like remote area housing. So talk to your employer, talk to HR or payroll about how you can salary package your housing in a remote area because that is FBT free. And the other one is technology. So if you want a new computer or a phone, if you're predominantly using it for work, then it is tax deductible and there would be no fringe benefits tax on that. So work can help you pay for that as a pre-tax tax deduction or money that comes out before you're taxed. And I have a calculation sheet on this one with a comparison between the two. So the example is superannuation. So somebody on $120,000 versus somebody who's salary packaging superannuation of $15,000. So taxable income, and remembering all the way back to the very first slide, taxable income is what you pay tax on. With no salary packaging, we're paying tax on the whole $120,000. Whereas with salary packaging, we're paying tax on that reduced amount, so $105,000. We can see there that the tax on this is significantly different. So $5,000-ish different. Then our Medicare levy is different. And so our total tax overall is different. So how does that impact you in the hand? So in the hand, you'll get $7,344 banked into your bank account if you're not salary packaging super. If you are salary packaging super, then you'll get $6,525 in the hand in your bank account. So that's a reduction of $819 in the hand, but $1,250, so $1,250 is going into your superannuation fund. So we're taking out $819 to put in $1,250, and that's because of the tax break. That's because of the before tax aspect. We're saving tax to be able to put more money into superannuation. So this one's really cool. If you can afford to drop your net pay and you do believe in the superannuation system, some people are a little bit cynical about it, then you can definitely put money to superannuation. And these calculations work for most of other salary packaging as well. So if you're doing salary packaging of $15,000 for a vehicle, then generally it would work similar to this as well. The magic, I like that word, the magic is in the pre-tax or before tax deduction. So having it up here before we're calculating your taxable income reduces your tax, but it doesn't give you a bigger tax refund because work takes out the right amount of tax based on your taxable income. So this is something to be aware of. And if you do have a help debt or a HEX debt, then take note of that because work will adjust the tax down, but there may be some extra taxes that you do need to pay on top of that. My last little tongue-in-cheek, you want to pay less tax? Well, earn less money because it will reduce the tax you pay because the more you earn, the more you pay. So a final idea or way to think about it, how can you reduce the bills that you need to pay so that you can reduce your work, get paid less? Can you work part-time and still live? How can you pay out your mortgage so you don't need to earn so much? How can you timeshare with your partner so that you both earn less than one full-time worker? How can you set up a business as a company, for example, and work for yourself so you've got control over how much you're paying for yourself? And how can you time the sale of your assets so they're taxed in a different tax year where you might be earning less than you are now? So lots of different ways. As I do say, the more you earn, the more tax you pay. So the less you earn, the less tax you pay. And it is a way to minimize your taxes is some timing issues. Another way to reduce your taxes is by making sure you're claiming all of the offsets that are available to you. So if you live in a remote area like Karratha, like Herman, like Robin, you can live in a remote area and claim a zone offset. So if you live in that area, then you can claim it. Now, it used to be, the rules changed for us. It used to be, if you even went on a holiday to a remote area, you could add those days in. Sorry, not anymore. So no more holidays. Can't claim anything for holidays, but you can claim for children. Okay, so if you've got children and you live in a remote area, then you may get some more back for your children. So if you're in Zone A, which is Karratha, $338 off your tax just because you live in an area. Zone B is those less remote but more accessible areas. So you think Kalgoorlie, it's only a couple of hour drive to, I won't say couple, it's only 4 or 5 hour drive from Kalgoorlie to Perth versus Karratha is 16 hours. And those special zone areas, so Onslow, Exmouth, up in the Kimberley, so Kununurra, Derby, those sorts of areas, they get $1,173 off their tax just because they live in a remote area. Now, I don't know about you guys, I've lived in a remote area, it cost way more than that. So these dollar figures are based on 1980s cost of living. So it's just a tiny perk to get more money. Then we've got your tax offsets. So offsets are those things that you don't need to pay for in order to reduce your tax. So we have covered a lot of things that you have to physically pay for to get a tax deduction. The tax offsets are based on your circumstances. So you don't actually need to be out of pocket for these things. And they're generally those special circumstances. So the zone offset, like I just mentioned, paying spouse superannuation contributions, paying a foreign tax offset, or paying foreign tax, and a carer's offset. So there's a few different bits and pieces. If you apply specific circumstances, you can get some money off of your tax. So it's just being aware that those offsets are available for you. Okay, we're at the end. My voice is starting to go croaky, so hopefully it's all good. So timely taxes. So the purpose of you showing up today was to figure out how you can minimize your tax, and hopefully I've given you some information that you can run with. And so I do recommend you work with your accountant to do tax planning before you come to tax time. So work out your taxes schedule for the year and hold some aside if you pay tax installments. So people who have a tax bill regularly when they lodge their tax returns will be asked to pay pay-as-you-go tax in advance. And so for me and my husband, we are unfortunately earning more money than what work takes out. So we have to pay tax in advance. And so we've got a bank account set up for taxes so that a percentage of money just goes into that every payday, so that we know when we've got those tax installments to pay, it's just paid automatically. The money's there, it's not stressful. Work out if your investment is working for you. So if you've got a negatively geared property and you're not sure if it's working for you, then use the tax planning meeting to actually go and work out whether it's making money for you or not. If you've got an office in another country, yes. Work out your salary packaging might impact how on your take-home pay. So you can do those calculations with your accountant. Work out if you want to set up a business, what would that look like? So if you would like to go into the draw and have a free tax planning meeting with me tonight to say thank you so much for spending an hour and a bit with me to learn everything, then please type yes into the comments now. And then tomorrow morning, I will reach out with a booking link for you. I'm going to do very random. Sorry, I will just see all of the yeses in the comments there, and we'll draw it by random, and I'll reach out with you in the morning and say thank you so much for joining me. And if you are the lucky winner, I will send you a booking link so you can book straight in based on my calendar. Now, thank you so much for coming along tonight. Thank you for asking your questions. It's been really good. I'd love for you to, if you do have any extra questions, stick them in the chat. I will stop the recording in a minute and answer anything else. But if you do want to connect with me, I've got a couple of different ways. My personal Facebook, Jodi Porteous Money Management Coach. Northwest Accountancy, can find us on Facebook, Instagram, LinkedIn, and then we've got a Pinterest site now too. Our website, northwestaccountancy.com.au, and you can also see this recording and lots of other recordings I've done for you on YouTube as well. So I'd love to connect with you and hopefully see you in any future training sessions or maybe around the time. Thank you. And my email address is on the slide as well if you've got any specific questions about tonight or any feedback as well. I'm going to stop the recording. So thank you so much.